Ben ritrovati lunedì mattina sul floor del New York Stock Exchange, gli indici sono in questo momento piuttosto deboli, il rientro dopo una settimana particolarmente positiva che ha spinto il Dow Jones su livelli record, ma ne parliamo con il mio ospite qui sul floor, come vedete è Kenneth Polcari che è il direttore delle operazioni sul floor per O'Neil Securities. Kenny, ben ritrovato.
How are you?
I am very well, how are you?
I'm good, thank you.
So Kenny, I was just saying that we are back after a brilliant week, well, a positive week we can say. We reached another record for the Dow Jones.
Right.
This morning is a little bit of uncertainty. Ukraine is still playing a big part?
You know, but it started really last weekend, or last Friday when you think about it, right? Because the market came out with such a great non-farm payrolls number, but yet the market had no real reaction, right? People were expecting with a number like we had that they would have taken the market to new highs. And in fact, we saw the market struggle because as you dug into that report, you realized that, you know, the unemployment rate came down so much that you realize that there were some 800,000 people that just stopped looking for a job. You know, they're frustrated with the environment. And so therefore, the report takes on kind of a different tone. Maybe it's not so positive. The quality of jobs is much more important than the quantity of jobs. And I think that's kind of what you saw. Then you had going into the weekend more rhetoric coming out of Russia and Ukraine about what the weekend was going to bring, what the next 10 days are going to bring, because this is a time in history where Russia and Ukraine originally separated over a 10-day period years ago, and so therefore there's this kind of nationalistic pride that wells up, and so there's some concern over that. And then you've got the elections on May 25th in Ukraine, and you know, the West is looking to see whether or not Russia interferes with this election, and if they do, what does that really mean? Is it another flashpoint for further violence? And so that's kind of holding the market in check, not only here in the U.S., but really markets around the world are kind of struggling as we move through this kind of geopolitical turmoil.
And it's a sense that this instability then, Kenny, might really play a role for the entire month of May until those elections.
And it might, and I kind of get the sense that we're through earnings season really for the most part in this country. We've got a couple of stragglers left this week, but for the most part, it came in right as expected. About 70% of the earnings beat the number, 25% didn't. The balance was just kind of in the middle, the usual story. And so now investors and traders from around the world are going to start to focus on the broader issues once again, you know, the broader U.S. economy, the broader European economy, what's going on in China and Asia, as well as then the geopolitical. So that could absolutely dominate the discussion and the chatter for the next couple of weeks, for sure, absolutely.
And this morning from China, we saw again another contraction of the manufacturing sector that really worrisome at this point.
Right, but you know, it's interesting. What we got was the HSBC PMI, which shows a contraction, versus the official Chinese number, which shows it better than 50. So they would be in expansionary mode, right? So we have this kind of yin and yang between the reports in China with people trying to feel it out. I will say that a lot of the earnings reports here in the U.S. Did not point necessarily to a weakening China that caused a lot of concern. Actually, there were some earnings reports that talked about the strength coming out of China. And so therefore it's a little bit conflicting, which is why I don't think you've seen China really fall off the edge any more than it has over the last 5 years. It's kind of stabilized. And nor do I see that we've seen the Chinese news affect really the U.S. market. People are comfortable kind of where it is, right? And so I think that's going to continue to be the case because I think the worst of China is over. Listen, we've discussed this before. China is down. If you look at it over a 5-year period, it's trading really at the lows. And so maybe, you know, in that sense, the worst is over for China. It's going to start to build a base here and then start to move higher, which is what I think is going to happen.
Now, let's go back here and in particular in the trading environment. This morning we heard from JP Morgan. We already were like worried about trading activities after, you know, the long list of earnings that we had from banks. But now JP Morgan expects 20% down of revenue from trading both equities and fixed income. What does this tell us, Kenny, that this quarter is going to be slow?
Well, you know, first of all, they came out with that news Friday after the market closed, right? There was some kind of concern on Friday, chatter about it, but they came out Friday after the bell and they announced this. Now, this flies in the face of, in February, he talked about trading revenues in the second quarter being down somewhere between 12 and 15%. Now they came out and said they expect them to be down 20%. So, A, what does that say for JP Morgan? What's that say for the rest of that investment banking sector, right? And so, therefore, that's just bringing further weakness, right, as we kind of adjust, you know, analysts adjust, the discussion adjusts around what the future really looks like. So it could be, that's certainly going to dominate in terms of in terms of how investors feel, and they're going to have to reprice not only the financial services sector, but then they're going to have to start to reprice really the broader market when they think about, well, was the forward guidance from the first quarter as positive as maybe people think? Are they going to take a step back? This is what I think is going to hold the market in check. I don't think, listen, it's May now, right? We've got that great adage, sell in May and go away. I don't think that's really the smart thing to do this year. Remember last year, this period returned 10% in the market, so that would have been the wrong move to make. I think once again it will be the wrong move to make because I think the market is actually going to set up for a better second half. Not without some concern going forward, but that's what the market will do.
Especially because the S&P from the beginning of the year is only up 1.8%. I mean, it's not that much. It's not an excuse to just leave.
No, it's not an excuse to leave. And listen, we've seen the Fed take $40 billion out of the quantitative easing program, and yet the market continues to hold in. That, on the one hand, is a positive sign. They've promised to keep rates low. They're not going to do anything with the rates until they finish with quantitative easing and see where the market is, and that will continue to offer some support, for the market. So any big sell-off, I think, is going to be very short-lived and muted. I don't think you're going to get a big sell-off.
We're going to hear from Janet Yellen again this week. Probably it's the highlight of the week. Not much, not big news are expected this week, but Janet Yellen will be in Congress. Now, Janet Yellen has still she didn't go back to what she said after her first press conference about the timing, the famous timing for the next rates rise. So what do you think might come from her speech?
I actually think she's going to be kind of a benign speech. I don't think she's going to pin herself into a corner. But over the weekend, we did hear from another Fed president. I think it was Dennis Lacker, who came out and said they weren't going to even discuss rates until October or November, based on where we see the economy. How did the market react to? By then, they expect to be finished with quantitative easing. How did the market react to that? What does the future look like? So I don't think you're going to get anything from Janet Yellen this week that's going to somehow back her into the corner at all. I think she's going to maintain the policy that they continue to be data dependent. They continue to look at these macro data points, and then they'll make a decision as they move along. So if anyone's looking for a blockbuster statement, I don't think they're going to get it.
And a quick note on the job data. You were mentioning them earlier, the numbers that we saw on Friday. The quality of the job created, as you were saying, is not good. A lot of still temporary positions, and still 800,000 people left the workforce. So do you think that we might see a revision the following, for the next few months? What is it going to happen? I mean, there's really momentum here or not?
It doesn't feel like there's a lot of good momentum. That's the problem. The number was a great number, much better than anyone had expected. But don't forget, the January, February, and March numbers were exceptionally weak, right? So if you kind of average it out over the 4 months, we're kind of right where we've been, which doesn't really give anyone that warm, fuzzy feeling. Listen, we need to create better than 300,000 good quality, well-paying jobs in order to get out of this mess that we're still in, and we're still not there yet. So I'm not feeling the momentum. You might get a little bit of an adjustment next month to this month's number, but I don't suspect you're going to get a massive adjustment, but nor do I expect that we're going to continue marching along at this number. It just doesn't feel like it.
Yeah, we're not there yet.
Not there yet.
Well, have a good week, Kenny, and thank you so much for being with us.
Thank you, and you too.
E grazie a voi per l'attenzione e a domani.